Hey folks, welcome to a product review at Finominal. Today we're going to have a look at Guggenheim's Macro Opportunities Fund, which trades on the ticker GIOIX. Now the fund is unconstrained and pursues a total return target and primarily allocates via fixed income. So what we would expect is a return stream that is uncorrelated to major asset classes and offers diversification benefits. So let's explore if the macro opportunities fund, does offer that. So if we look at the fact sheet of GIOIX, we do see that as benchmark, they have selected short-term US Treasuries. And we can use that index. And if you use this and look at the performance of GIOIX since 2012, we do see that the fund has significantly outperformed their benchmark, as well another benchmark that we're showing, which is the Bloomberg 1-to-5-year Government Credit Index, which is more like the benchmark based on statistics that is more similar to the performance of GIOIX. Having said that, just eyeballing these charts, it seems that the benchmark is perhaps a little bit too low risk for what they are actually doing, because you do see that one, the return is significantly higher and the drawdowns as well, right? So I would challenge them that this is the appropriate benchmark. But let's find out what would be a better benchmark, right? Or perhaps similar peers, that you can compare this fund to, as we explore what is actually driving this fund. And what we're going to do as a next step is look at a returns-based factor exposure analysis to see what has been driving the risk and return of this fund. Now, over here we see the factor betas to major asset classes since the inception of the fund. And we do see that the exposure to the S&P 500 is small, but consistently positive. We also do see the exposure to the US aggregate bond index, which is primarily investment grade bonds, is, well, time varying, right? Positive, negative, positive. Over the last couple of years, it was positive. We also do see that the exposure to the US dollar index is mostly zero, but there were times when the exposure is negative, which simply highlights that the fund had exposure to either international equities or international bonds. And it is worth recalling, right, that this fund is unconstrained, right, with regards to the asset class it can invest in, and is pursuing a total return objective. Now, given that the fund had a consistent positive exposure to the S&P 500, kind of indicates that the diversification benefits were likely on the lower side. But we can evaluate that, for example, by looking at the drawdowns of the fund in recent bear markets and stock market crashes. So here we see effectively a drawdown analysis since 2012 of the Guggenheim Macro Opportunities Fund versus the S&P 500. Now, what we do see, of course, that the drawdowns of the S&P 500 were significantly larger, but of course the return was also significantly higher. We do note that the drawdowns of the Guggenheim Macro Fund most of the time happened when the stock market declined, which again is just a validation, right, that you have positive equity exposure, right? We can see during the 2022, right, when bonds and equities declined, right, the fund had a drawdown. During COVID, it had a drawdown, and so on. Now, we do see in general that the line of the Guggenheim Macro Fund, right, that there were like no drawdowns over here. And that I think is largely a function of the returns data being provided either to us or by Guggenheim directly, in a sense that this fund does have a daily returns, but it doesn't seem to be a lot of mark-to-market happening, which from my perspective indicates that the values are somewhat stale. Now, but I'll come back to this later on. Now, so this is from a risk perspective, and as mentioned, I find it somewhat surprising, right, that an unconstrained fund with a focus on fixed income had basically drawdowns most of the time when the equity market had drawdowns, because that simply indicates, right, that fund does not offer the diversification benefits that we perhaps would like to see in an unconstrained total return fund. And we can also have a quick look at the correlations of the Guggenheim Macro Fund to the S&P 500 and the Bloomberg Ag Index, right? And we do see that the correlation is 0.37, which is fairly high for, again, a global unconstrained total return fund, right? That is focused on fixed income. Not so much surprised by the moderate correlation to fixed income, right? Because primarily this fund holds MBS, CMBS, treasuries, IG bonds, right? And other fixed income instruments. Now, this is for the fund on a standalone basis. And theoretically, I could say, like funds are other global macro funds. But in this case, I actually do think that is the wrong peer group, right? Because most other global macro funds are more uncorrelated. And I think actually in this case, the right benchmark is more high yield funds. And that's simply because a high yield fund does have exposure to equities, like this fund does, and does have exposure to fixed income, like this fund does, right? High yield, from a capital structure perspective, sits between equities and fixed income. So let's see if I'm right about that. So over here, I'm going to compare just the Guggenheim Market Opportunities Fund to two high yield products, one a mutual fund from BlackRock and then one ETF from iShares. And we're going to have a quick look at the performance. And what I think we're going to see that effectively, well, here you see the performance since 2012, and effectively, right, GIOIX, right, performed well, somewhere between those two products, right? As you can see, it's exactly the same trends, right? And effectively, well, behaves like a high yield product, right? Which, yeah, is verified by the correlations. Now, earlier I mentioned, right, that the returns of GIOIX seem a lot smoother, right? Which you can also see over here, right? The high yield mutual fund and ETF seems much more volatile. I think this is down to whatever this fund is doing from a mark-to-market perspective, that either it has it's mark to model and not mark to market on some of those fixed income positions, right? But that's more fake volatility rather than market volatility, because you have to sell them. You look at the mark to market, right? So discount that. And that kind of already summarizes our short review of Guggenheim's Market Opportunities Fund. As mentioned, the objective is to provide an attractive total return by investing unconstrained across asset classes with a focus primarily on fixed income. Now, having said this, the fund charges 90, in this share class charges 92 basis points, which is not cheap. And effectively, you get the same return profile as a high yield fund that you can buy at a much lower cost, right? The management fees for this mutual fund or for this ETF from iShares and BlackRock, right, are around 40, 50 basis points. And so it's somewhat questionable, right? Why would you allocate to the global macro fund, right, if you're effectively getting like a high yield product? That's it. Hope that helps. Have a nice day.